Well, welcome to the Unintimidating Guides to Understanding P&Ls. My name is Dana Van Voorhis. I am a division president at a global food distribution company. And I want to start today by acknowledging the land in which I live and work is the unceded territory of the Coast Salish people, including the territories of the Musqueam, Squamish, and Tsleil-Waututh nations. And I'm grateful for the opportunity to do so and to connect with all of you today. So I have three disclaimers to start this talk off with. First of all, as you can see on the screen, I'm a crazy cat lady, and I would not be surprised if one of my two cats end up showing up tonight on video, possibly multiple times. I love them with all my heart, but they love to show up and show their pretty faces as well. My second disclaimer before we start is all of the numbers in the presentation today are completely made up. So they're not based off of real companies. They really are made up to make sense to what we're talking about today. So if you're trying to read into them too much and try to figure out all the ratios that we're not talking about, I'm not sure if they're real. It just worked for our examples. Even the numbers that I'm going to reference in my own story and my own background are still not really actual. They're just more rounded numbers in my own personal story as well. So just know all the numbers are just made up. I'm also not an accountant, so there's going to be words that I say that are not official accounting language, and that is okay. The good news about me not being an accountant and not coming from the finance part of the business means that I'm going to talk about P&Ls in non-financial language. I'm going to try to bring that down in a different way that is going to be a little bit more unintimidating and a little bit more friendly, and I hope that you get a lot out of this. So about my background, I have spent the last 11 years in food distribution and production. I started off my career really in the sales and marketing side of the business. Started off in marketing projects, moved over to overseeing all of our international business development for my company down in Southern California. And when I was 26 years old, I got a really big promotion. I was asked to move from the sales and marketing space from that Southern California company and moved to a different company in Southern California that was a sister company of ours as the director of business operations. And I only had one actual job description with this role. It was to make the company profitable. But as I just referenced, I have no financial background. I haven't even actually ever taken a business class. I'm a science major from college. So I had to figure out all of these documents and all of this profitability, these financial statements, all really on my own. And I had to do it really, really quickly. So I had to attend my first senior management meeting. I was so excited. It's the first time I was invited. And this is what showed up on the screen. Now, don't try to read this. Lots of little numbers. All of the things that we present today will be a lot easier to read than this. But this is what came at me, and I was so intimidated. How am I supposed to read this? There's so much going on. Oh my gosh, what am I supposed to do? But I also knew that this was going to uncover all the secrets that I needed to do my one job, which was make the company profitable. And I had to learn this really, really fast because we were bleeding a lot of money. At the time, we were losing about $50,000-ish. And we really needed to turn this around. So I needed to get really, really friendly with something that looked very scary and intimidating and figure out how I could use all the information on this sheet to turn our business profitable. And 2 months later, we were profitable. It was amazing. Our profit that first week was less than $100. It was quite small, but it was the first time this company had been in the black in a very, very long time. And my boss and I celebrated like you couldn't believe. We went out to lunch, which we had to pay with on our own dimes because our company couldn't really afford to reimburse us on this. But it was really the big starting point for profitability for this company. And we grew and we grew and we grew. And about 6 months after I joined the company, we had all the bigwigs of our corporation come in. They wanted to know what we did to change our profitability. They wanted to know how the business was going. My boss and I were both new, and they just wanted to do a nice business review with us. So we had to put together a lot of different documents. And one of the things that I was asked to put together was just a simple graph that showed our profitability before we arrived to today, every single week. And that graph pretty much went straight up. And I was talking about it, presenting it, telling them what I did. And my boss's 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 boss, the biggest of the bigwigs that were in this very intimidating meeting, took that graph and he looked at me and he said, Dana, you're going to have a performance review coming up. And when you have that performance review, what I want you to do is I want you to take this graph, I want you to put it on your boss's desk, and I want to just say, you're welcome, and walk out. And that's how confident he was in what I was doing. And I didn't know at the time how important that meeting was, how important what I did was, because I was naive. I just was told I was supposed to make it profitable. I did what I was told I was supposed to do. And that was really the jumping off point of my entire career. I would never be where I am today at a very young age, climbing that corporate ladder, if I wouldn't have understood our P&L and I wouldn't have had the opportunity to dig into it and to figure out how to change the numbers on this great document that we sit and we look at every day. So today I'm going to try to do this. I'm going to teach you, or at least hopefully get you to the point that you understand the P&L, you know how to interpret your P&L, and hopefully even how to love the P&L as much as I do. So I promise it won't look as nearly as scary as this. We're going to work on demystifying this terrifying income statement, this terrifying document, and break this down into things that make a lot of sense and that you can use in the future to impress your bosses just as much as I used to impress mine. So we're going to start with the basics here. What is a P&L statement? A P&L statement, also known as a profit and loss statement, shows revenues, expenses, and profitability over a period of time. Really, it's asking you, are we making money and how are we doing it? So we're going to start with an imaginary chicken company. Now, I know this is a very unusual example, but we're trying to make this as simple as possible. So this company only does one thing. Most companies do a whole lot more than one thing. But this one is just going to take 1 pound chickens pieces and sell them. So one item, one thing. No company in the world makes it this simple, but this is going to help us really understand what they are doing and how these numbers work. So at this point, I'm going to say, feel free to follow along with the included spreadsheet as we work through these numbers. You will see a bunch of different companies on them. We will start with the first company and we'll move on, but these numbers are provided for you. So we sell chicken to grocery stores, and we sell these 1 pound increments of chicken for $7.14. On your P&L, this is going to be what's called sales or revenue maybe. That chicken costs us from our suppliers $5.71. This is going to be known as the cost of goods sold, or the COGS. When we subtract what we sell it for from what it costs us, we're going to get $1.43. And this is going to be our gross margin on the P&L. But we have expenses. We have a building that we have to either own or lease. We have employees we have to pay for. We have packaging materials. We have a lot of different things. So we have expenses. So for every pound of chicken that we sell, we have $1 of expenses. And this is called your total operating expense. And when we subtract these two numbers from each other, we're going to see what we actually make, what our true profit is, which in this case is 43 cents for every pound of chicken. And this is also known as your operating income or your profit. So let's make this look official. This is what you're going to be looking at for your simplified version of the P&L. All of these categories are really going to be on most P&L statements. And this is what you would expect all of these numbers to really boil down to at the end of the day. So when you see something like this and you're really stressed out and it looks like a lot, just know it really is just this. So one of the fun things to note is that we have some jargon that comes out of P&Ls that we actually use in our day-to-day life, including the bottom line. That's really what we talk about with profit, because at the end of the day, it's what matters. It's the bottom line, but it also is what's at the bottom of the P&L statement. It also, we talk about the top line. We talk about sales or revenue, top line growth. This also comes because sales line is at the top of the P&L. So just to review, sales is just what we sell it to our customers for. COGS, or cost of goods sold, is just what that item cost us from our suppliers. When we subtract those, we get our gross margin, but we have expenses, our total operating expenses. Now we subtract those and we get our operating income or our profit. At the end of the day, what do we make? And just for fun, because we love to confuse everyone all the time, there are a lot of accounting terms. So there are a lot of things that companies may use instead of some of these other terms. So instead of sales, your company might put on their P&L revenue or net sales. Instead of gross margin, you might see gross profit or gross profit margin. Operating income has a lot of terms. This is just a small smattering of them, but there's a couple different areas that you might see, including just simply profit. So know that if your P&L doesn't look exactly like this, all of these components are still there. They just might be called something else. So let's go back to this P&L statement. At the end of the day, we are making 43 cents for every single pound of chicken that we're selling. So my question to everyone is 43 cents per pound of chicken any good? Seems kind of small, but is that what we expect? Do we think it should be bigger? Let's see if maybe we can clear it up by looking at this at a larger scale. So instead of one piece of chicken that we sell, maybe let's look at all the chicken that we sell over an entire year. So what we're going to do is we're going to take this, we're going to multiply everything out by the amount that we sell in a year, which is 35 million pounds. And our numbers change a bit. So our sales are now $250 million. Our COGS, or cost of goods sold, are now $200 million. When we subtract those from each other, we get a gross margin of $50 million. And we have our total operating expenses at $35 million. When we subtract those from each other, we get our bottom line profit of $15 million, also known as our operating income. So $15 million is a lot more than 43 cents. So is this company doing well? Yeah, this company is actually doing really well. But this isn't something that you're going to know without understanding our industry and the industry that I personally am in. So we're going to talk a lot more about that soon and how that can help with your industry and how unique your industry is as well. So tonight I'm going to teach you what I see. I have a systematic way of going through these P&Ls to take a lot of these meaningless numbers and turn it into a set of success or useful indicators so that you can run a successful business. So we're going to have 7 essential checks that we're going to go through tonight. And this is what we really want you to remember, is these 7 checks every time you look at a P&L, and it's really going to give you a lot of answers to that scary document. So the first check is just simply, is the profit positive? It's really what you want to know first, because at the end of the day, we want to know, is our company making money, or do we have to make some drastic changes? So when we go back to our example, we can see right away, well, $15 million is absolutely positive. So we're going to mark this as green and say that this checks our first check that we're looking at. But is $15 million of profit good? Would it be better if it was $50 million? Would $1 million still be good? We sell $250 million. How much should we expect to have off of those amount of sales? we really need to take ourselves and look at another way of checking this to see if we're making enough money. So check number 2 is it profitable enough? And for this, we have a very handy metric called operating income percent. Operating income percent is just simply the total operating income or profit divided by the total sales. And it's really what percentage of your sales become profit at the end of the day. It's a very important metric that all of us are looking for that are analyzing our P&L. So let's do the math for us. Our total operating income or our total profit is $15 million. And we divide this by our total sales of $250 million. With that, we get 6%. So is 6% operating income percent any good? Is 2% good? Is 1% good? Is 10%, 20%? What is good? Well, in our industry, 6% is great. In my industry, we expect an operating income percent of anywhere between 0.5 to 6% to really be on target for what we're looking for. But obviously, a lot of people aren't in my industry, and you're going to be wondering to yourself, well, what am I supposed to have for my company? So NYU has put together a really handy tool for everyone that you can look at, and Holly's going to share with you, that breaks down the operating income percent that we expect by industry. So you can see software is at 20%, oil and gas down at 3%, biotechnology at -1%. They literally plan to be negative, and that entire industry is negative, which is incredible. So there's a lot of variation between industries. And if you don't know and it doesn't show, your industry doesn't show up on NYU's handy chart, you always can go to your CFO or your finance friends to ask them what you would expect for your operating income percent, or how much of your profits or how much of your sales turn into profits at the end of the day, and what are the targets. And if no one can give you that answer, Google is always your friend, and you can always Google it as well. So this is where you see operating income percent or OI percent. It's always listed under your operating income or your profit. And because that check number 2 was positive, we were within our range of 0.5 to 6%. We're going to mark this green and say that this is yes, it did pass our check. So we've gone through the first 2 of 7 checks. Is the profit positive? And is it positive enough? Or what is your operating income percent? And is that in the range you expect it to be? So now we're going to use a different chicken company. Imaginary chicken number 2. And we're going to have a new set of numbers for them. So their sales are going to be $300 million. Their COGS, or cost of goods sold, what the chicken costs them that they're going to be selling, is $233.25 million. When we subtract those, we get a gross margin of $66.75 million. Then we have our total operating expense of $76.75 million. And you may be already seeing what's about to happen when we look and subtract those to get our operating income or our profit of $10 million. So -$10 million isn't going to pass our first check of is the profit positive. And then when we add our operating income percent, we're also going to see that because it's negative, it definitely doesn't fall into our 0.5 to 6% range that we're looking for. And we're also going to highlight that as red, and it doesn't fail, or it doesn't pass. So why aren't we making any money? Well, it's very important to remember that profit is just how much we make minus how much we spend, or how much we have for gross margin minus total operating expense. So at the end of the day, when you're talking about profitability, growing profitability, or why are we not profitable, those 2 metrics, gross margin and total operating expense, are going to be your key. How high is your gross margin? How high is your operating expense? And what do you need to do to change those are going to be the keys to this puzzle. So check number 3, Are expenses too high? And again, we have a handy metric. Our metric is going to be operating expense per pound. Now, this is the total operating expense divided by the total pounds that we sell. We want to see if these numbers can get as low as possible. Lower expenses is always good for us. So let's do the math. We have a total operating expense of $76.75 million, and we're going to divide it by $40 million or 40 million pounds. When we do this and we do the math, we get that we have $1.92 a pound of this operating expense. So is $1.92 a pound operating cost per pound any good? No. Actually, in our industry, we're really going to be looking at $1 to $1.50 a pound for our operating expenses per pound. Now, you're going to sit there and say, my industry, we don't sell anything per pound. So how does this relate to me? Well, every industry is going to be a little bit different. Honestly, every company can be a little bit different. But what you're looking here is some kind of ratio of operating expense per unit of sale. So let's say you're a mining company and you sell gold. It might be your total operating expense per ounce of gold that you sell. It might be that your company makes machines that other companies use. So it might be total operating expense per machine you sell. Or you might be service-based and it might be total operating expense per customer you have or something like that. And you're just looking at how do you relate your operating expense to some relative unit of sale and how that goes and how high that is or how low that is and how it changes over time. So operating expense per pound is what we're going to talk about tonight, and that is going to be listed, and whatever your metric is going to be listed under the total operating expense. And because we said our range was $1 to $1.50 a pound, we're going to list this as red because $1.92 is quite high. So could we say that our total operating expenses is the reason why we're losing money? Maybe, it might be. But there's one other metric that we want to explore as well, because remember, profit is gross margin minus total operating expense. So we also need to be looking at, do we have high enough markups or margins? It's important to note that markups is another word for margins. We wouldn't say gross markups, but we often talk about how the markup to the customer is, and that is the margin that we're getting. So we're going to talk now about gross margin percent. Gross margin percent is just simply our total gross margin divided by our sales, or what percentage of our sales is represented by our markup. The higher the numbers, the better. We would love to charge our customers a gross margin percent of 90% and make a lot of money. But every industry, again, is going to be a little bit different. And really, some of your customers won't be able to pay for that large of a margin. Some customers will. Really depends on the industry, which we'll get into a little bit later. So in this example, we have a total gross margin of $66.75 million, and we have total sales of $300 million. When we divide those, we see 22%. So is 22% gross margin percent any good? Yes. In my industry, we're looking for a gross margin of around 18 to 22%. So this is absolutely a great gross margin percent. And again, NYU has that handy tool that you can look up at the different industries and see what their gross margin average is. It won't really give you that range, but it definitely is going to average that out. So we can see that gross margins are a lot higher than our operating income percent. Software up with 72%. We see mining at 37%. We see that biotechnology, which loses money at the end of the day, all the way up at 62%. So sounds like their expenses are quite high. And we can see this very, very much by industry. So this is where you're going to see the gross margin percent. You're going to see it right under gross margin as your helpful indicator. You're going to notice that all of the indicators that relate to that top number that you're always dividing by something like sales or pounds, they're always right under that metric that is associated. So here it's under gross margin. And we're going to list it in green because it's 22% and it passes our 18 to 22% range. So at the end of the day, when we look at this, we see that we think that expenses are where we're going to need to look into a little bit more to see what we can do about changing our profit. So we're going to make a little bit more room and we're going to actually look at our expenses in more detail. Most of your P&Ls will look more like this is going to look, where you see a total operating expense, but you see subcategories that make up that expense. And that's really helpful for when you're trying to figure out what's going on with your business. So in this case, we have our first line of expense is $7 million of warehouse expense. In this industry, warehouse, you're going to be using to both receive the chicken from your supplier and you're going to store it in the warehouse before you bring it into production. And then after it comes out of production, you're going to put it back in the warehouse for storage before it is shipped out to your customer. And that's really the associated expenses. It's going to be that labor that is the shippers and receivers. It's going to be the machines that you use in the warehouse, like cherry pickers, and that's going to make up that total expense. Then you have production expenses. So what we are doing in this company is we are buying big boxes of chicken from our suppliers. So 60-pound boxes of chicken. Then we're opening those up, we're portioning it all out into 1 pound increments and then packaging it into small packages that can be sold at the grocery store. So a lot of our business is in this production area and a lot of our clearly expenses are also associated. So 33.5 million of our 76.75 million is all in production. And that's really the labor that goes into opening those boxes, portioning out that chicken. It's going to be the machines that do that work with the people. And it's also going to be all the packaging associated with the process. Then we have a transportation expense of 8.5 million. And really what makes up this is just going to be your drivers, your trucks, the maintenance for those trucks, and gas. And then we have SG&A. This is also known as G&A, and it stands for Sales, General, and Administrative. And if it's G&A, it's just General and Administrative. And this is a lot of headcount expense. So it is going to be representing your finance departments, your sales departments, HR, all of your executive salaries. So it typically is one of your largest expenses on your line items. And then we have occupancy expense. This is 2.75 million for this company. And in occupancy, you typically see expenses that are shared by multiple departments. And when I say that, it's a lot of times like the building that they're working in. So maybe property taxes, the mortgage, possibly rent for the lease. It can be utilities. It's going to be things that you're really going to need to spread out across the entire company. Those go into occupancy expense. So how do we improve this? Well, there are some questions that we want to ask ourselves. Which category is the biggest? Obviously, the bigger the category, sometimes the most that you can influence that category and change it, the more opportunity you have. How changeable are the expenses? It's pretty hard to get rid of the building. Those leases are long. You may have to go through the process of selling. It doesn't happen overnight. So how changeable are those? How controllable are those expenses? That's something you want to ask yourself before you start tackling these different buckets. And then which has the more complex processes? You know, how many more opportunities are there to maybe make something more efficient or better? The more complex the process, typically the more that you can play around with them to make them more efficient or cut some things down. So when we go here, we are going to look at these expenses. And so I'm going to put my hat on as someone who analyzes this and looks for areas that I might tackle first to try to see if I can reduce our expenses down. And we talked about what's your biggest expense. So we see production and then we see SG&A. Both of those are very big. Well, SG&A is a hard expense to change because it is really headcount. So unless you're completely overstaffed, that one is one of the harder ones to change. So I would probably put that on the back burner for the beginning of this. And then the occupancy expense as well. That one is what we talked about, that building, and it takes a long time to move out of a building. So you might not be able to affect that as much. In this company, it's quite small, so I probably wouldn't be really going after it in the very beginning anyways. But it is something that you would still look at over time. Are we using utilities that we don't need? There's some questions there that we can answer. But really what I would be going after personally is the warehouse, production, and transportation expenses. And I would look down at that bottom and say, we're negative $10 million. Warehouse and transportation both don't even make up $10 million independently. So probably not going to look there first, probably going to look more in our production expense because of how large it is. It's also quite a complex process, which we love because there's a lot of different areas that we can look at for how we can make that more efficient. So that would be where I would personally start if this was my own P&L. But I would also look in all of the expenses over time just to see if we can keep moving those down and bring our OPP down to the range that we're looking for. And in our case, it's $1 to $1.50 a pound. So we've now gotten to our 4 out of 7 essential checks. Is the profit positive? Is that profit positive or profitable enough? OI percent. Are those expenses too high? What's your operating expense per pound? Or in your company, it might be something else, but what is your operating expense divided by some unit of sale? And then do we have a high enough markups? How is our gross margin percent looking? And these 3, OI percent, some kind of operations percent or operations per unit of measure, and gross margin percent. These are really your key metrics. These are the ones that as you get really familiar with your P&L, your eyes are going to go straight to that every single time that you see your P&L and make sure that they are in range. And the reason why we're looking at those far more than we're looking at the actual numbers is that the actual numbers mean nothing without context. You may say $15 million of profit is great in that first example, but if we don't really understand what that is compared to the amount of sales, it's not really important. It's pretty meaningless. We really want to know is how much of our sales we drive down to profits. And that's why that OI percent is so important. And it's the same thing with our margin and our expenses as well. And that's really why these are the key metrics that we always focus on. But we do have 3 more checks. So we're going to move on to imaginary chicken company number 3. So this company has a whole new set of metrics for their P&L. They have their sales of $100 million. They have their cost of goods sold, their COGS of $85 million. We subtract those to get our gross margin, which is $15 million. Then we have a total operating expense of $14.75 million, which is going to give us our operating income or our profit when we subtract those of $250,000. And when we look at check number 1, is the profit positive? We see yes, the profit is positive. So now we're going to look at our other checks. We're going to make our room and we're going to see our OI percent falls a bit short. It fails because it's not between 0.5 and 6%. But at 0.3%, we're really close, which is good. That means that there's not as far that we're going to need to move this company to start looking at good in our metrics. So again, since profit, it's gross margin minus total operating expense, we are going to want to look at our other metrics. We see that our operating expense per pound is $1.05 per pound, which is looking really good because we're looking for $1 to $1.50 a pound. And then our gross margin here is 15%. And this one fails our check because it is lower than the 18 to 22% that we're looking for. So just like we did last time, we know that margin is where we want to take a little bit more of a look. And again, in your own P&Ls, you're most likely going to have multiple things listed under margin that's going to help you diagnose where the problems are. So we're going to look at this in two different areas. We're going to look at invoice margin. And invoice margin is the selling margin. It's really what we mark up to our customers, what our costs were that the salespeople see in our system to what we sell it to the customer for. So in this case, that's $8 million. Then we have production income. And we have two parts of our building that we work through. We have margin that comes from that selling piece, and we have margin that comes from our production piece. And in this case, it's $3.85 million. Now, not all companies are obviously going to have production margin because not all companies produce something. A lot of companies don't have this margin bucket, and they may only have invoice margin, or they might have a couple of other margins that are broken out as well. It really is going to change from company to company. But typically, all companies are going to have an invoice margin that they list. So, okay. Now, what do we do with that? We just said we had two different margins. Well, we're going to need to have check number 5. And this is going to be, are we charging enough to cover production? So what we're looking for is our production income to cover our production expense. And again, your company may not have production, but there might be a margin that has an associated expense that it would be offsetting. And we would always want to make sure that our income or our production margin or income is going to be higher than our expense, because again, profit is margin subtracted by the expense, and you want to make sure your margin is higher. So you want your income or your production income or your production margin to be higher than that production expense. So when we look at this and we subtract these, we see that that production income at 3.85 million does not cover our production expense of 5.5 million. So what we're going to do is we're going to change this to red. And we're going to say, no, this did not check number or did not pass check number 5. Then we move to check number 6. Are we charging enough to cover everything else? So we took out production, we took out the production expense, and we put it on the side. And now we're going to look and say, does invoice margin cover all of our other expenses? So invoice margin should cover our total operating expense minus our total production expense. We just said we put that over to the side with the production income or production margin. And we look again and we see invoice margin of $8 million is definitely not covering all of our other expenses of $9.25 million. And we're missing that by about $1.25 million. So that doesn't cover either. But we're not actually losing any money. We are making $250,000. So how does this even work? Well, we kind of lied to you. There are more margin buckets than it looks like here. And these margin buckets are a little bit different than the other two margin buckets. So we're going to talk about first earned income. Earned income is my personal favorite margin bucket because it is a very broad margin bucket that a lot of things fall into. And those things are really operational efficiencies. And because I am a person that comes from a lot of operations background, I love operational efficiencies. So this could be an example that when we bought our chicken, the market price for chicken was $5, but we actually bought it for $4.75. We were able to wheel and deal. We were able to maybe make a huge buy, leverage something in our relationship with the supplier, and we were able to sell it for or buy it for 25 cents under the market. So what we might do is we might say, we're going to discount to the customer by 15 cents a pound because we want to make sure that we're getting as many customers as we want. And obviously we have a lower price than we know where our competitors are. So we want to give them some of that. But we're not going to give them the full 25 cents. We're going to keep 10 cents for ourselves. And we're going to put that 10 cents in this earned income. That's the good job from the buyers of what they were doing and their relationship with their suppliers. But the thing is this doesn't happen every week. We're not always able to buy under the market. If we were always able to buy under the market wouldn't be the market. So it's not something we can always rely on. It's also something that could be in production where we decide that we have a yield and that's how we cost all of our chicken off of. Well, if our supplier brings us skin on chicken and we're making skinless chicken and we already know that the chicken skin should be about 10% and the boneless skinless chicken should be 90% when we buy it, and the supplier sends us chicken that is really, really, really cleaned up and that skin is only 5%. Well, we're actually going to make a lot of money because we expected for that skin to be 10%. That's how we costed it to our customers. So that's going to be money that we actually make. Whereas also our suppliers might send us more skin than we expect. They might send us 15% skin and we're only expecting 10. We costed our customers on 10. So we're going to have to absorb that cost in our business as well. We can also do some more efficient cutting in our room. We might cut better than we expected to cut, and that is all going to fall into this earned income. So again, it's not money that we expect every single week. It's not something that we can always plan for, but it's always something that we want, always something that we're working really hard for. And that goes into that earned income. Think about it, we earned it. Then we have this other adjustments category. And this is a pretty common category that you'll see in a lot of P&Ls as well. And a lot of this is inventory adjustments. It even might be called inventory adjustments on your P&L. And a lot of times you're just going to see that inventory changes value. Sometimes you have some spoiled product. You weren't able to use it in the shelf life that it had. And so you're going to have to write that down. You'll hear the word write down a lot. And that's really changing the value of your inventory. You're getting rid of that in your inventory. You're bringing your inventory value down. So you're writing it down. You may also, in your operations, forgot to scan a box and things happen. You do a physical inventory count and you thought product was there. You had it in your inventory, but you also have to write that inventory down. Every once in a while, you'll see some positives in other adjustments, but it's not super, super common to be positive. It's typically some kind of write down, so it's mostly a negative number. But as long as it's pretty small, most companies just understand that it's part of the doing business of the company. So in our example, earned income is saving the day, right? Yeah, we absolutely would not be profitable if we didn't have that $5 million of earned income. And so it's something that you love, but it's not something that you can always rely on. So when we look at it, we want to say, what else can we do to improve profit? If I can't rely on earned income every single day, I'm really going to have to make sure that I'm looking at this invoice margin and this production margin that seem to be really low compared to our expenses. So when we're looking at margins, we're going to look at the margin buckets that we have the most control over. And in this case, for this company, what you're going to do to increase your gross margin percent is you're going to have to either raise your production income or your production margin, or you're going to raise your invoice margin, or you're going to do a combination of both. So this is going to bring us to another check 6. So this is a 2-parter, and we're going to say, are we charging enough to cover everything else? Again, because we have another handy indicator. We have our invoice margin percent. This is the total invoice margin divided by sales. This is going to be, in our example, $8 million of invoice margin divided by $100 million of sales, which is 8%. So just like I've asked a lot today, is 8% invoice margin percent good? Hard to know that without knowing the range. And in our industry, 8 to 12% is what we're looking for. So in fact, yes, it is in our range. And we're going to be showing our invoice margin here, just like the others, underneath the invoice margin metric. And we are going to list this in green because we are saying that, yes, we're okay with this. This hits our 8 to 12%. So, Dana, what are you going to do to increase this gross margin percent, to increase your operating income percent? Well, I would look at this in one of 2 ways. invoice margin at 8% tells me that I still have some wiggle room there. And remember, with the first part of check 6, we weren't covering everything else with that invoice margin. So there's definitely room to grow there. But there's also production income, check 5, that we also weren't covering. So I have the decision of what do I want to do first. And personally, for me, I would go after production income first. And that's really because invoice margin is set by sales. And it's a lot harder to execute some change through someone else that's having that relationship to the customer, that's very wary about raising prices to customers, and ask them to keep driving it up, especially if we're in the range of invoice margin percent that all of our salespeople know that they need to be in. So I'm going to go after production income first. And I'm going to look at that and say, I have control over production income. Someone in my company does, that's not sales. That's just where we're setting our prices for those production items. So we would probably start there. We would start to raise that up. But it's always important to note that anytime you're raising up your margins, it does mean that the customer is seeing an increase in price. So you always have to be very smart about how you do this, but you also know with your indicator of gross margin percent being under where you expect for the industry, that you do have wiggle room here. It's just always a scary wiggle room for companies to have because they're always wary about margin. But in this case, your operating expenses are great. There's nothing else to cut. You just have to raise your prices to make more money than the money that you expect to have. So in our 7 essential checks, we now know that are we charging enough to cover production? Yes or no? And are we charging enough to cover everything else? And we have our handy metric of invoice margin percent to look at that as well. And now we come to our last company, our imaginary chicken company number 4. So this company has sales of $35 million. It has a cost of goods sold of $27.3 million. When we subtract those, we get our gross margin of $7.7 million. We have a total operating expense of $9.45 million. When we subtract those again, we get our total operating income or our profit of negative $1.75 million. So we know check number 1, it's not going to pass. We are not profitable. And then we're going to move this down. We're going to see OI percent definitely not passing as well. Negative 5% is not positive, and it's not within 0.5 to 6%, and it's pretty far off. So we're going to add our OPP, or operating expense per pound. We're going to see that this is also high. It's up at $1.89. And so we're going to list this as red. And then we're going to add in our gross margin percent. And we actually have a good news story here. It's 22%. So we kind of know where we need to look. We need to look at our operating expenses. So we're going to add those in. So now we're going to go with the easiest one to evaluate here, because we learned about check number 5 before, which is production expense has an offset in margin with our production income. So we're going to add these in, and we're going to see that our production expense is about $250,000 higher than our production income is. So we definitely know that we have at least $250,000 that we can try to cut in production expense. But when I look down at the bottom and I look at our operating income or our profit, I see that $250,000, while we could use anything, it's not really going to cut it. It's not going to be enough, and it's not going to make a huge difference. So we're going to need to look at some other categories, and we're going to put production expense in red. So what else are we going to look at? What's wrong? Well, I took some time. I analyzed this imaginary company's P&L, and I have to tell you there's something different here. So the pounds, I'm going to add this in. We haven't seen this on many of our other P&Ls. Some of your P&Ls will have a unit of sale like this. Mine always do, but some do not. So we haven't always included them. But these pounds are 5 million pounds. If you remember that first example way back, our pounds in that first example were 35 million. And that wasn't even the largest company that we had. So 5 million pounds, it's quite small. And it's important to note that there's a certain amount of expenses that a company is just going to have naturally to be able to turn the lights on, to be able to run the business. So you can't always cut all the expenses. You may need to look at the size of the company and are all of those expenses making sense for the company? So we're going to now go with our last and final check and talk about check number 7. How high are our fixed expenses? So there's two kinds of expenses out there. There are fixed expenses and there's variable expenses. Fixed expenses are those expenses that are going to be there no matter how much or how little you sell. So these really are going to be a lot of your building. So your lease, your mortgage, your property taxes, your utilities for that building to turn the lights on, those are really fixed expenses. Might be the machines that you bought for that business that you need to be able to run that business. All fixed expenses. But then you have variable expenses. Packaging is a great variable expense. You use packaging when you're selling that product. You don't use it if you don't have the business. So that expense is going to go up and down with the business. Same with a lot of our labor, especially our operations labor. We get more labor when we need it. We reduce our labor when we don't need it. And we really are able to flex with the business. It's really important to know how much of your expenses are fixed versus how much are variable. So when we go into here and we do a lot of different research, we're going to talk to our finance team. We're going to dig into these numbers a little bit, and we're going to find out that our SG&A, or our sales, general and administrative expense, and our occupancy expense are both quite high for the amount of business that we're doing in this company. So we have kind of two options here. We can either fire everyone and move, or we can grow our sales. And, you know, I always try to avoid doing any kind of firing or moving buildings. I only want to go up, not down in size. So let's hope that they're going to grow their sales. And that brings us to all of the essential checks, all 7 of them that we talked about. Is the profit positive? Is it positive enough? OI%? Are expenses too high? OPP, or operating expense per pound, or in your company's case, it might just be operating expense per unit of sale. Do we have high enough markups? Gross margin %? Are we charging enough to cover production? Are we charging enough to cover everything else? Are our margins that we have control over covering our expenses? And then how high is our fixed expenses compared to our non-fixed expenses, our variable expenses? So this was a lot. So I'll take a deep breath. Let's kind of realize that we're almost done with this marathon. This is a long talk, but there's one last thing that we haven't talked about. So we looked at this P&L statement in the very beginning, and we've kind of missed this end of this. Shows revenue, expenses, and profitability over a period of time. So let's take Imagine Chicken Company number 4 that either needed to grow or needed to reduce those really high expenses and look at them a year later. So we're going to start with our 2021 numbers that we just talked about, and we're going to show our 2022 numbers. Well, let's go through our checks. We see that our profit is suddenly positive. Our OI% is 1%, which falls into our 0.5 to 6%. Our operating cost per pound just went down to $1.47 a pound, which is well within our $1 to $1.50. And our gross margin stayed at 22% and is still green. So all of our metrics turned green. And it's really important to note, look at this growth. We really grew our pounds, and that really grew that profit. So this talked about how we've moved those fixed expenses from being a huge part of our expenses to actually being a very small part of our expenses. And those variable expenses, the ones that change when we have more business or less business, grew quite a lot with this. but it's still a little hard to tell what those changes are. So we're going to add a column and we're going to look at the difference or the variance, and we're going to list them here. So to get this difference, all we do is we take our 2022 numbers and we subtract our 2021 numbers, and we can see how much we grew in this case. It might be how much we shrunk in other cases. And we can see a lot of new things. So first of all, we're able to see that our gross margin didn't change at all, which is incredibly impressive because most of the time when you have to grow sales, a lot of times you cut your margins to do so. And this company didn't do that. So that's fantastic. And you'll also talk about those two other expenses that we talked about before. SG&A, that they had too much headcount, they had too much sales on their books because they were gonna grow sales. They had forward invested in it. Well, that didn't need to change. And then their occupancy, their building, those expenses related to the building, that didn't need to change either to bring on more business. But again, while these numbers help, they don't help us completely. So we're going to actually add one more column. And this is the percent difference. When you talk financial language and you hear a lot of your bosses talk, or your leaders talk, your finance people talk, they often talk in percentages. It's just an easier number. So we're going to add those as well. And all this is when we take the difference, fiscal 22 minus fiscal 21, and we divide it by the original date, which is fiscal 21. So we can actually see what the growth was, or the shrink, and it was negative. And we see here very easily that through our sales, pounds, costs of goods sold, our gross margin, and our production expense, all by 50%. So our business grew 50%, which is phenomenal. And we had associated production grow too, which kind of makes sense. All of these pounds that we make are production pounds, so it makes a lot of sense that that would go up the same. But we also see that our warehouse expense and our transportation expense only went up 20% instead of that 50%. So we actually can even show where we got more efficient with our business. So maybe those trucks that were going out before weren't going out completely full, and now they are. So they didn't have to buy 50% more trucks. They only had to get 20% more trucks and drivers. So we can show when we look at the no change with SG&A and occupancy, the 20% with warehouse and transportation, that really brings a 50% growth in sales to only 17% growth in expenses. And that's really what changed everything here. And then we look and we see that our operating income has gone up to positive. It's grown by 2.26 million, which is absolutely incredible, and grown 129%, the largest of all of the growths here, which is exactly what we want to see. Our expenses didn't go up, so those margins just dropped right to profit. So this is what you use to go to your boss, and you tell them a great news story. Boss, we grew by 50%. We were able to retain our margin. We were able to leverage these efficiencies in our operations to only increase our total operating expenses by 17%. And we grew our operating income by 129%. I am amazing, boss. That's what you're going to tell them. And that's what they want to hear. They want you to tell them their language. What happened with this financial statement? And you can really only do that by comparing this over time, comparing last year and this year, showing what happened with this. Because a P&L statement of the moment doesn't mean a whole lot when you don't know where you're coming from. So you always want to compare it. But there's one more comparison we also want to do. We also want to look at plan. Now, I am sure you have heard something about your plan or your budget for this fiscal year, for the year you're in right now. All companies pretty much live and die by plans or their budget. This is the jargon we use all the time. We're always looking at how we are doing compared to the plan that we made a very long time ago. Well before the fiscal year even started, we have committed to our investors, to our shareholders, to our bosses, what we are going to do that next year. And we have put it down. And now you're going to see that your P&L statements are often going to be comparing your actuals to what we planned. So let's look at the fiscal 22 that we've actually done, that we just showed. And then let's look at next the plan. What did we plan to do? So clearly this company expected to grow. They clearly had too big of a building. They invested in sales early and they knew that they were going to grow. But it looks like we grew a little bit more than we thought. So again, we probably need to look at the more columns to make sense of this. So we're going to add the difference, and we're going to see that we still grew by 2.5 million from what we expected to do. Again, we kept our gross margin exactly where we wanted it to be. Production expenses, we actually did better because remember, we sold more pounds or more dollars as well. And we had the same amount of the production expense that we thought. So clearly there was some investment there, and we actually leveraged some great operational efficiencies as well. And then we can see that we actually only planned to have an operating expense per pound of $1.50 a pound, and we were actually able to do a lot better there. And thus we were able to do better on our operating income percent, and we were going to grow that by 0.5%. So we're very happy with that. But again, we love the percent difference as well. So when we add that, we see a couple more things. Well, we did better by 5% over plan. We can see that maybe the warehouse expense was a little worse than we planned. Maybe we had a couple of forklifts that broke down and we had to invest in a little bit more. Maybe we have something else that we saw that we didn't expect to have, so we had to spend a little bit more there. But we can still see that we grew 3% or 5% over our plan, but our operating expenses were still smaller at 3%, which was where we were able to see double the profit that we expected. And even though this was an amazing turnaround, still doing double the profit of what you planned is amazing, and your boss is going to be unbelievably happy. So here's the good news story we're going to tell our boss. We're going to say that we had an aggressive sales growth plan, but we still exceeded it by 5% without discounting our margins to get this business. We did so by increasing our expenses only 3% for our 5% growth and improved our operating income by 1% over plan or by 100% or 94% over plan to 0.5%. We doubled our overall profit to 510,000. And you're again going to sit there and say, we're amazing. Look at how amazing I am. And look at what we did. So again, just like you want to compare to last year, you want to see where you're coming from. You are always going to be comparing to your plan because that is what your company committed to. So it's always something that you're looking at. And then there's one more thing that we do. We look at our plan constantly. And we look at it in multiple different areas. Week to date, month to date, quarterly to date, yearly to date. How are we doing in each of those time periods compared to our plan at the same time? So we remember this big, scary document that we talked about in the very beginning. Well, all this is a lot of mini P&Ls. And while that might sound scary, it's really not. They all add up to each other. So we're going to show you what they really mean. And again, you can't read these numbers, but this is what it's telling you. It's telling you the daily actuals versus the planned daily numbers. And then you get your difference and your percent difference on that. You get your weekly, same thing. What is the week to date numbers versus what would the planned numbers? Monthly versus plan, quarterly versus plan, half yearly possibly versus plan, year to date versus plan. What's your full year forecast now versus plan? And what was that year-on-year number? What was fiscal 21 versus now fiscal 22? And all of those have the difference and the percent difference on them. Now, not every company is going to look at all of these ones. I know personally, I only look at weekly, monthly, quarterly, yearly, but other people are going to look at more. It really depends on your industry. So we showed you a good smattering, but your P&Ls might not look this intimidating. They might look a little bit more manageable. But remember, we've already talked about all of these things. We just have to look at this big, scary document, take a step back and just say, this is just simply what we already talked about multiple times. So let's sum it up. Going back to the very beginning. Sales is just what we sell to the customer for, what we sell it to the customer for, the total sales dollars. What are the COGS? They're just what the chicken cost us to buy from our supplier. That's the cost of goods sold. When we subtract those from each other, we get the total gross margin. And then we have expenses, our total operating expenses. We now need to take the gross margin, subtract the expenses, and you're going to get the total operating income or our profit at the end of the day. And we have 7 essential checks. Check 1 is just simply, is the profit positive? Step 2, 3, and 4, these checks are key metrics, remember them. Is it profitable enough? Operating income percent. What's the total operating income or profit divided by the sales? Are our expenses too high? What's our total operating expense divided by unit of measure that we sell? In our case, it was pounds. In your case, it could be a couple different things, but you're looking at what your operating expenses are divided by something that is in sales. Do we have a high enough markups? Gross margin percent. Gross margin divided by our sales. How much of our sales is our markup? How much money do we have to cover our expenses to get our profits? And this is just where they all sit. We talked about it. There might be subcategories under margin. There might be subcategories under expense. I would probably say most companies do have those. They're not what's reported out to the public, but they are what you use in your internal documents because you need to know what those are to be able to see what might look off and what you can affect. And we just remember, at the end of the day, profit is just how much we make minus how much we spend. It's just the total gross margin minus the total operating expense. And if we remember that those are the 3 metrics that all relate to each other, and when we're worried about profit, we know we can increase margin or decrease our operating expense, and that's how we're going to affect and bring that profit up. Then we have a couple more of once we identify if it's going to be expenses or if it's going to be margin, we have a couple more things that we look at. So are we charging enough to cover our expenses? So if you have something like production income or production margin, is that more than your production expense? Is your invoice margin more than all your other expenses that it needs to cover? Is your invoice margin percent, invoice margin divided by sales, is that at the right range? And then how high are our fixed expenses? Are our fixed expenses really high? Almost always going to need to grow sales at that point. You want your variable expenses to be the big part of your expenses. Fixed expenses are really hard to reduce, and you really don't want a lot of them on your books. So increase your sales. And then we're going to need to look at this over time. We want to show what happened from last year. We want to know what the story is. If you're working on your P&L, you need to show where you started and where you went. When I talked about what that graph from my boss, all I was showing him was our operating income or our profit over time, every week. And that was what was so incredible to him that he wanted me to show it to my boss as my entire statement for my performance review and just walk away. That is something that's very important. We want to show it over time, show what happened before. So this year versus last year. And then plan is king or queen of all of our business. It is everything that we're looking for. It's what we talk about every single day. It's what all of our investors, our stockholders, our bosses are all looking at. So we want to know, how are we doing today versus our plan? What did we plan to do, and are we achieving that plan? And we look at it over time. We look at it weekly, hopefully. We look at it monthly. We look at all these different metrics so that we can see how we've affected our P&L over time. Is our gross margin growing or is it shrinking? Is our operating income growing or is it shrinking? Is our expenses growing and shrinking? And we can look at it when we are able to see that all in one not so scary document anymore. So I hope you feel the happiness and joy that I do whenever I see this now after all of these numbers and this very long, probably a lot of information coming into your brain. But just know that this P&L hides all the secrets of your business. This P&L tells you where you need to go next. It's not going to teach you how to do it, but it's going to help you go in the right direction. And sometimes you're going to have to try a couple of different things. Sometimes all of your indicators are going to be in the red and you're going to have to affect a lot of them. But this is how you're going to take your career to the next level. This is how you're going to knock your socks off your boss, like I did to my boss's 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 boss all of those years ago. And honestly, this is how I have succeeded in my career. And I know that you can succeed in your careers the same way too. So get comfortable with this document. It is your best friend and your best tool. And I hope that after today, you feel a lot better about it and it feels a lot less intimidating.